Jennifer Kim from Invesco PowerShares, one of the largest, most well-established ETF providers in the industry. And then next to Jennifer, we have Jeremie from Robo, who is an index provider that has one thematic product in the market that they work with ETC on. So that being said, I'll turn it over to Debbie, and we can kick off the panel.
So I'm Debbie Fuhr. Good morning, everyone. It's nice to be here. I've covered the ETF industry since 1997, spent 11 years at Morgan Stanley, 3 years at BGI BlackRock, and then 6.5 years ago set up ETFGI, an independent research and consulting firm. So we're based in London. I've lived over there for 24 years, but as you can tell, from the US originally.
Hi, I'm Mike Cronan. I'm with ETC. We're one of the largest white label providers for ETFs, and I worked at ETF.com, where I got to know Debbie's data quite well. And about 3.5 years ago, I started a marketing consultancy company, and then about a year ago, I joined ETC once we realized that our clients were mostly similar. So we help companies, basically market themselves and build AUM, and it's been a sort of a great ride, and it looks like I'm always doing startups, which is it's a lot of fun.
Hi, Jennifer Kim from Invesco, soon to be formerly PowerShares. As Tom mentioned, we are the 4th largest ETF provider globally with regards to assets. We have products both in the fixed income, domestic equity, international equity, commodity and currency space here and globally. I actually started my career as an ETF trader on the American Stock Exchange as an ETF specialist, and I'm now obviously part of the PowerShares family or the Invesco family on the capital market side.
Hi everyone, I'm Jeremie Capron, Director of Research with Robo. We are the creator of the first index to track the robotics and AI revolution for investors. Well, 5 years ago, we put together a team of investment professionals and industry experts, including some of the most renowned roboticists and AI researchers around the world, to tackle this investment opportunity. And today, we provide the intelligence behind a variety of investment products, primarily ETFs, the largest one being Robo, that's with ETC here in the US. We also advise on active strategies for Asian clients. Before joining Robo, I was an investor and researcher in robotics and factory automation, worked as a sell-side research analyst in Asia, and most recently here on Wall Street.
Thank you. And just for the record, I'm Tom Champion from the New York Stock Exchange. I am part of the ETF group there at the exchange. We list a majority of the ETFs and ETPs, including ETNs and other structures here in the US. Okay, so I guess let's kick it off. There's different representation here. There's white label, there's a large ETF issuer, there's an index provider. Maybe we can talk a little bit about how each one is different and how they view the industry differently. And maybe we'll kick off with Jen.
Sure. So being a more established ETF provider, we like to focus on kind of complementing what can we provide our clients. So it's a more well-rounded experience. We come with a full infrastructure of capital markets, marketing, compliance. So as we greet our clients, we want to make sure that they're comfortable, especially the new entrants to the ETF space. I think this audience isn't, I guess from a show of hands, how many in the audience are ETF users currently? Okay. It's hard to see with the lights glaring, but
it looked like about third to a half.
Okay.
Yeah.
Okay, great. So I think as an established ETF issuer, I think we have the luxury of really supporting our infrastructure. So what that means for me from the capital markets perspective, how do clients experience ETFs for the first time? Do they have a good trading experience? Do they listen to everything they read in the papers about ETFs being, the end-all be-all worst thing to the universe? No. So we like to use our resources to really help clients through that process. So making sure that they have a good client experience. So from the execution process, helping them understand how to trade ETFs, helping them align with, who are liquidity providers and how can they best access those ETFs. So providing some of those type of support services. I think our product lineup also, given, the more extensive lineup in the commodities, equity, fixed income space, we don't, I guess, a little bit different from some of the other panelists up here, so we can kind of pass it over and let you guys talk about some of your models.
Sure. So, as a white label provider, we help index providers and sub-advisors bring their products to market. We provide them with a whole host of services along lines with compliance and with setting up and using our exemptive relief. And we have exemptive relief for all categories of assets. And from them, we're basically their consultant, and we provide that consulting services to them to help them navigate all the legal hurdles and then go to market and then navigate the capital markets teams and work through all the issues that a new or experienced issuer or product would have throughout the sort of growth cycle. So we're really that partner that helps you grow, whether it was working with Robo when they were at 100 million to now being 2.5 billion. The issues are very different, and so we have that wide bench of people like Jay Baker and Garrett Stevens that have had the experience to really tell you what to expect next. And so that's really the strength that we bring. But for startups, like we're working with a foreign government to bring in a new commodities ETF to market. And so, working through all those hurdles, really the experience that we bring to them. And then to the end user, to the advisor, what we want to do is bring the best quality product so that they know where it fits in their portfolio and then how best to use it. And so those are the sort of dual roles that we serve.
Jeremie, you are a partner with ETC. Maybe you can explain what that partnership is like and what your experience is in partnering with somebody to do an ETF with a firm like ETC.
Sure. So today we work with a variety of partners around the world, ETC here in the US, legal in general, over in Europe, Samsung, asset management in Asia. So, we're experiencing quite a wide range of partners. And I have to say that when the idea came up 5 years ago to set up a proper investment strategy and offer investors exposure to the robotics and AI revolutions, we weren't quite sure that ETF was the right vehicle. And we explored all other avenues, mutual funds and et cetera. But what was very clear was that the index approach, and particularly that hybrid of a research-driven index and the discipline that comes along with index investing was particularly suitable to an ETF vehicle. And our experience with ETC has been excellent. They've been great partners, essentially enabling us to focus on the intelligence behind the investment strategy, and having ETC take on all the tasks around, from marketing to compliance, was extremely helpful. So I think it's hard to find something that was better than an ETF when we got started. So today we touch on other types of investment products, and clearly it's a lot more complicated from our perspective.
And what's your thoughts, Debbie? You have a lot of experience here in the ETF industry. You probably have an unbiased opinion of different types of ways to list an ETF. Maybe share some of your thoughts.
Sure. I think from an investor's point of view, I think what they want to see when they look at products is they want to make sure that they understand the benchmark. I think they often look at size, they look at trading volumes, they look at costs, they look at a number of factors. And I think it's important to have a good website that explains the product, the methodology. For many, the question is a little bit even higher than just kind of thinking about, should I go with one type of issue or another? But it's like, should I use an ETF, as Jeremie was saying, or should I use a future, or should I use a closed-end fund or something else? So what are the benefits of one type of product over another is the more typical question people ask. And then when you have multiple products that are similar from different issuers, then people will look at those firms. And I think depending on who you are, some of the challenges will be for smaller firms is getting onto the platforms of the big banks, right? So it's, do I have access to all the different products? So I think from an investor's point of view, one of the key benefits of ETFs here in the US is they are more tax efficient than traditional mutual funds. And so by that I mean, if you look at the in-kind creation redemption that happens with ETFs, that means that there's less capital gains paid out to remaining shareholders in general when you use ETFs versus using a mutual fund. And the fees tend to be lower. People like the fact that they are transparent, so you can look and see what's inside of a Robo. So what does that mean? I think there's a lot of interest in kind of disruptive technology and other things coming to market, but often people don't know what those terms mean, right? And even the SEC is concerned about companies saying, I'm a blockchain company now. Well, what does that mean, and are you really?
I don't think you can even use that in any of the names
I
of
know.
those products. So.
So I think the ETF, because they always have been really transparent, have actually offered a lot of benefits to small investors to be able to very easily learn about products. I think the challenges often have been that in many countries, and over the years I've been to 60 countries around the world, in many countries financial advisors are paid to sell other products, so they tend to deflect away from ETFs the minute someone asks and go to the products where they get paid to sell them. Here in the US, you're lucky that that doesn't happen. So I think that ETFs have really made an evolution in the way people invest. And I think the other thing that's really important is, and I'm not sure if we're going to get to this later, but robos. I mean, I think many people today go to robo-advisor platforms to learn about investing themselves because they're not even aware of how to have a conversation with you guys in the audience who are advisors, right? It's like, if I haven't done this before, I can go to a robo and figure out what should I know at least at a upper level about asset allocation. You learn about ETFs because those tend to be the products on the platform. So I think that it is important to look at the issuer, but I think it's more important to look at the product. Are they fully replicating? Are they optimizing? What is the structure? Is it really an ETF? Because I think the other thing is you find in the US that everything is called an ETF, but at times you might be buying a note or a partnership or something else, which will mean the way you're taxed is different. So if you buy, say, a gold product, you might be taxed as if you own a collectible. You'll have different counterparty exposure, and many of the notes that are issued by US firms no longer will do creation. So a year ago, June, or actually more than that, they said that they will no longer create, they just will redeem if that's what is out there to happen. So I think you need to look at the products and make sure you understand them, because they do what they say they do on the tin, but if you assume, I think that's when you make a mistake.
Okay, so, and I think you brought up an interesting point, and we'll try to get back to robos later, but so what you're saying is that you're not only need to look, when you're interested in buying a product or an ETF, that not only do you have to look at what that product is, but you need to look even further behind it. Who's issuing that particular product, and who and why are they issuing that product?
And maybe go back, so I'll even go to a really high level. The first question you have to say is, what exposure do I want, and what are the ways I could do that? And then come down a decision tree.
Do you have anybody else have any thoughts on that?
Yeah, I mean, I used to run research at ETF.com, so my job was basically educating advisors on how to look at ETFs and how to sort of drill down, and the way that platform is set up, and it's ETF.com/ticker. You can basically look at 4 levels. You have the overview, you have basically all liquidity, tradability, and fit, and it just shows you basically everything you need to know from creation size, if you want to do block trades, or liquidity, and it gives you a really good profile score on liquidity and performance, and it really allows you to drill down. So that's one tool that I still use, and I make sure all my clients are aware of that, because that's what people are looking at beyond Yahoo Finance to really kind of drill down and understand what they're buying.
And I already know the answer to this question, but Jennifer, how important is ETF education to the end users?
Yeah, that's actually what I was going to comment on too. And as Debbie was saying, I think it's, and unfortunately or fortunately, the onus is on you, the investors or the financial advisors or those advising clients and kind of upholding that fiduciary responsibility. You really can't judge a book by its cover, as cliche as that sounds. You can't judge an ETF by its ticker or by its name or even by the issuer. You really want to, dive in. If you've made that decision, okay, ETFs are the vehicle for me. Again, to Debbie's point, am I investing in an ETF versus an ETN? Do you really know what an ETN is? Does an ETN hold the underlying securities like an ETF? Not necessarily. So really understanding that and acknowledging if you don't understand, ask questions. And that's where your issuers can really step in and answer those questions. Know, especially for new users, but even the more sophisticated ETF users, Herb shaking his head, yes, ask the questions. I think that's where you can really lean on any ETF provider, anyone in the ETF industry. We want to kind of expel some of those untrue myths out there about ETFs. So I think if you want to know what is the index methodology, what type of exposure am I really getting, ask your providers, ask the exchanges, ask people on the research side. People in this space definitely want to answer those questions and they like to hear them, so don't feel embarrassed or think that you should know, it says it's a low vol ETF, is it really low vol? Or it says it's a smart beta ETF, what does that really mean? Because a lot of that is really just branding and marketing, the same way that they try and catch you in CPG, they do that in the ETF industry as well. So make sure you do your due diligence and understand exactly identify what you're looking for, answer the what and the why are you doing something, and then do your due diligence to understand, okay, are you actually getting what you think you're getting and what you're being advertised to get.
Yeah, and I think maybe to just expand on what Jennifer said, which is great, if you look at smart beta products, the way the index providers create min-vol, each one is really different. So even the indices are different. So it is important that you do your homework and understand that. So I think the big thing is the American term, don't assume, because when you assume, you make a, so that is.
Okay, maybe we'll switch gears here a little bit, talking about different ways to list an ETF, different types of ETF issuers, and sort of what the expectation is in investor education. Over the last few years, we've seen a lot of growth in the smart beta sector, ESG, and thematic type products. Do you see those trends continuing? If so, why? Is there another area of growth in ETFs that you see outside of those? And we start off with you, Debbie, here.
Sure. So we have seen growth in smart beta, but as Jennifer said, this is really now a marketing term because many of those products have existed for 15 years, right? But smart beta has been around maybe 3 years. So the reality.
Smart beta.
Pardon?
Before it was called smart beta.
Exactly, yes. So we have seen growth in that space, but what I would say is it is interesting that the largest ETF that just celebrated its 25th anniversary, SPY, still takes in huge flows every year, right? So, and that's unusual because usually a first product kind of runs out of steam at some point. But so what we're seeing is I think ESG is becoming popular, I think partially because of Trump, right? So Trump pulling out of the climate accord in Paris has caused people to look at this. You saw Michael Bloomberg say he's going to put some of his own money, as have others. So what you're finding is the way ESG was calculated historically meant if you were going to do good, you were giving up performance because basically it was negative screening. They took out tobacco, firearms, pornography, and maybe some other stuff. Tobacco stocks tend to have high margins, and so those sin stocks perform better than not sin. The methodology for ESG has changed a lot, and some people go as far as to say that's now smart beta. I think you need to do your homework, but I think many people are looking to have impact in the way they invest, especially millennials. I think thematic is becoming very important, so disruptive is something many people are looking at, and also looking at playing things that are happening out there in the world, whether it's clean energy or some other, robos, 3D printing, you name it. So I think it's smaller in terms of the amount of money that's going to go there because Tom's not going to put all his money into clean energy, right? Probably not anyway.
I was thinking about it, but no.
So what I think is going to happen going forward is I think people are using ETFs in different ways. So I think they still use them as core beta building blocks. And I don't like to call ETFs passive because what you find is most people are saying, I can't find good active funds that consistently deliver alpha for every allocation I want. I'm going to use low-cost beta ETFs to implement exposure to get alpha through my asset allocation. And I'm going to use some smart beta and themes and other things around the edges. So I think people are slowly starting to use smart beta. A third of all the assets there are in high dividends. So people are using it because they want income, not because they want something that is smart beta in the truest sense that we think about. So I believe ETFs are going to continue to grow very significantly. We made significant growth forecasts for assets, and they're going to grow by institutional users, financial advisors, and retail, and around the world. Today we have over 7,000 ETFs listed on 70 exchanges in 57 countries. So there's even 24 ETFs in Iran, believe it or not.
Wow. Mike, you see a lot of different people come to you with different ideas in some of these categories. What are you guys seeing in this space?
Yeah, no, I mean, we get pitched about 5 to 10 new ideas a month, so we see every new idea practically coming to market. We see thematic as still being very hot. Everyone wants to launch a crypto ETF when the SEC will allow. I heard
that's next week, but no.
Yeah, I'm assuming there are going to be about 25 to 50 cryptos if that ever gets approved. And then, so ESG is also big. We have 7 ESG products. We're actually looking to build an ESG portfolio using those products because we have the Vident large cap, international, and bond ESG products, so that gives us a nice core, and then we could add in our thematic, like biblically responsible, or honor, which is a military ETF, or pride, which is a LGBT ETF from UBS. And so I think we're going to have a nice portfolio of ESG products to bring to market. And then fixed income is still an area we're seeing a lot of product development in, and sort of these inflation hedged income products is another area that we're getting a lot of conversations around. So I think all of those areas, and then active as well. A lot of active managers are bringing their strategies to us and are looking to build it. But we're just we're really trying to put water on a lot of these ideas because it's gotten to be so crowded that if you don't have 25 or 50 million, we're just like, maybe you should, kind of think about, this twice. And then if you want to go large cap equity, we're like, well, do you have 100, 200 million? Because I don't think you really understand what you're going after. So we're trying to, make sure everyone is not just, I'm going to have $2.5 million in seed and we're going to be successful. It just, I think those days are gone, actually.
And Jennifer, what is Invesco PowerShares up to in these different categories?
So I can't necessarily speak to product pipeline. We obviously have many products in filing. I think Invesco and PowerShares really, we were one of the innovators in the smart beta space before it was tagged as smart beta and became the marketing phenomenon it is now.
I think you listed your first product in 2003.
Exactly. So, we obviously feel very strongly about the smart beta space. We're focused on the factor space, so both on the equity side and then also how does that translate into the fixed income world. So that's something. ESG is also something that we're very passionate about, both on the legacy active Invesco side as well as the passive ETF side of the business. So you can expect to see more from us probably in some of those spaces.
And Jeremie, maybe discuss a little bit about the benefits of thematic investing, and do you see other opportunities? I know you're focused in one area right now, but do you see other areas that you're going to think about focusing in?
I think ETFs are a great vehicle for thematic investing. I think thematic investing is going to continue to grow for a number of reasons. Number one is the world is changing at an unprecedented pace. So particularly on the technology side and disruptive technologies, I think the traditional global industry classifications are not appropriate for investors to capture the growth and returns opportunities that are presented by these technological transitions. We've seen that expressed in a way with the FANGs phenomenon, and how difficult it was to get the exposure to those companies that led the markets for several years now. I think the low cost benefit of ETF is really important. I would echo some of Deborah's points before: tax efficiency and transparency. So you're investing around a theme. What are you actually buying when you get a share in the ETF? That's really important. There's a ton of technology funds out there that are a lot less transparent, and I think it's difficult for investors to see what's under the cover. The other point I would make is when it comes to investing around themes and technology, the index approach has had a pretty good track record. If you think about the biotech revolution, for example, investing in biotech was an extremely difficult exercise. And if you bought 5 or 6 companies that were part of the biotech index, you probably end up losing everything. Whereas if you own the index, you had phenomenal returns because you could capture a handful of companies that went up multiple times, that were the real winners. And in the case of robotics, automation, and AI, we're exactly at this point, very early in terms of the adoption. We're very early in terms of the development of these technologies. It's very hard to identify who the next big winner is going to be. So in terms of thematic investing around technologies, I think ETFs are going to be the right way to go.
Okay, my next question will lead into a follow-up question, but we've seen actively managed ETFs catch on over the last couple of years, mostly in the fixed income space, very little in the equity space thus far. And we can start with you again, Debbie. Do you see that as a growth driver for the industry?
Well, yes and no. I think the challenge is that most active equity managers don't want to provide daily transparency on their underlying portfolio, right? So right now, the SEC's view is that ETFs should be providing daily transparency. So as Tom would know, there's hundreds of filings to potentially launch non-transparent active ETFs. The SEC has been concerned about this, stating that without transparency, the ETFs may not trade close to their net asset value. So they have not yet approved filings from many of the large active asset managers who today would like to be in the ETF space because they see that people like you want to use ETFs for the benefits they offer. So I think that's one where I'm not sure that the SEC sees what the benefits is also, which is another challenge. Not that they should be questioning that and preventing products from coming to market for that reason. We do have the Advanced Exchange Traded Managed Funds product, which is not an ETF. It's end-of-day pricing plus or minus. That is active in many of the offerings underneath that, but not the same. What we have seen, though, there are a few. So you see ARC has come out and has been willing, Kathy Woods, to do transparent equity active. And she has been gathering assets because she's in the space of disruptive technology. And so she's happy. Pardon?
Great performance, yeah.
And she's happy to go out and talk about what she's doing and why. And if anyone's interested in this space, they publish amazing weekly research too on what's going on, not just about their stocks. So I do think that active is interesting, but the reason we've seen fixed income grow is because fixed income managers are less concerned about that transparency. It's harder to follow what they're doing, and they're not so concerned about front running, so they're concerned on the equity side. So I think if the SEC was to approve non-transparent active, many active asset managers would convert existing funds into ETFs, because the challenge when you move to active is typically fund selectors want 3 years of track record on 100 million. So if someone comes out with a brand new ETF with no track record and no assets, it's a little bit of the old chicken and egg. How do you get to 3 years and 100 million? So I think we'd see the growth in assets be pretty quick because people would look to convert, because Vanguard has the only share class model and they patent that, and their patent goes to 2022. So unless someone wants to challenge it or ask them for permission to use it, which I'm not sure they would give, you're kind of stuck.
Anybody else have thoughts on actively managed ETFs? Is it something that you think is going to catch on, or is it going to continue to grow? Any thoughts behind the non-transparent or type structures?
Yeah, we have a number of actively managed ETFs, and some have done quite well. And what I tell people is, with T+1 disclosure, anyways, it's really hard to front run your trades. So, unless what you're doing is really not your research. Let's say you're more of a specialist on an area and not really doing all the hard research to come up with the new companies, where it's a longer term growth opportunity, then you're not going to be front run and you're going to be first in, and if someone's following you, that's going to drive your stock up. So so I'm less concerned about that, but and I do see it as growing. So I think that people are going to get over that hurdle and they're going to move over, and then I also think that people are going to maybe buy other ETFs and change the ticker, and then all of a sudden have a track record and go to market with a lot more assets. So I think some of those tricks are going to be coming down on the active side.
Okay. What about on thematic type ideas? Does it make sense to do that in an active wrapper, or does the index wrapper work well enough for you?
So our current strategy, I think, really works well with index. Reason being, it's a mix of research and it's a selection of companies around the world that lead the robotics and AI revolution. Is really a research-driven process involving not only investment professionals but also industry experts. So when you come down to that universe, and you want to build diversified exposure to all these companies, the index approach is great. What's great about it too is that the discipline that comes around buying and selling. So we have a quarterly rebalance process in place, which means that naturally every quarter you're going to be selling your stocks that have gone up and buying those that have gone on cheaper. And that discipline is something that perhaps is the key to performance, and perhaps one of the pitfalls that active managers need to work against. We're actively considering other strategies. We're working on active funds for other clients, and the reality is that it's very hard to beat the index. So I'm sure we'll see the conversion, as Mike talked about, and if the door gets open, and the benefits of ETFs will attract a lot of active managers too.
And I think with regards to transparency, you have to remember kind of the three core, I guess from the beginning of the ETF, the three core benefits of ETFs. One, they're lower cost, they're tax efficient because of the in-kind mechanism, and they're transparent. Transparency both to the investor and understanding that, but also transparent to those making markets and trading those products. If you take away that transparency, there needs to be a process or something in place that allows market makers and liquidity providers to effectively trade that basket, price that basket, and hedge that basket. Without that, the trading of that vehicle, that ETF, becomes significantly more difficult, and that impacts how investors can access that ETF. If a trader can't hedge their basket, then that's going to be reflected in the price of the basket, in the spread of the basket, and how you access it. So there are other implications. You have to deal with, how are the portfolio managers going to protect their secret sauce, but also then how are the market makers and the traders going to trade that, which ultimately impacts how you all will access, those products.
One area I also think we're going to see some interesting new products is exposure to China. So MSCI deciding to include A shares into their mainstream indices. And it also relates to comments here where today we don't have a lot of indices that reflect the fact that the stocks that are going to be going in are the 222 stocks that are in what's called the Connect program, which offshore investors can get access to. So we're seeing new indices come to market. We're also seeing an interesting stat that just came to mind as we're talking about this. It is getting more difficult to launch and keep products successfully in the market. This year, so far, through the end of April, we have had 117 ETFs close. That is a record number of closures. And if you look at if you kind of say a really successful ETF, like a category killer, is one that has $1 billion in assets. Globally, there's just 659 products out of that 7,300, and they account for 83% of the $5 trillion in ETFs. And in the US, there's like 350 products that have over $1 billion. So the challenge is when you get to that big size, everyone migrates to that product because it trades a lot, spreads are thin. If you want to lend them out, you can. If you want to borrow them, you can. And so getting to that threshold category killer makes it harder for Me Too or similar products, I think, to come in with 2 million and compete, right?
Yeah, absolutely. And that's why we're recommending that, you have to have that, because everyone coming to market also wants to be $1 billion.
Yes.
It used to be where they were like, if I get to 250 million or even 100 million, that would be okay because I'm making money.
Yeah.
That's no longer the case.
But it's harder because many people will talk about hack and say, if
Right.
one guy hack could raise $1 billion,
Right.
I've had a lot of European managers want to come to the US and they're like, if he could do it,
Right.
I'm a big firm, I should be able to do that.
Everybody wants to do that.
It's not that easy.
Yeah.
Looks like we're getting low on time here. I had some other questions I would have liked to ask. Maybe Nicholas can give us a little bit more time next year. But I want to open open to the audience if anybody has any questions. We got a couple minutes here left. Herb?
Yes, first, Herb Knight of ETF that we're known by all these people here. Yes. I want to thank Deb for the excellent market structure conference she had 2 days ago. Anyone who wants to know about these issues they're talking about in greater detail and with the best education I've seen, take a look at that market structure conference as well as this, which of course is always the flagship. Also, our people next week, Quaffew, who's a media sponsor of this, we're having blockchain event, and that's open to all. Now, the question I have is full circle given the theme of this conference. Closed-end funds when ETFs came to market, a lot of people thought closed-end funds would go out of business. In fact, there's still a live and vibrant market, obviously, for them because they do offer some structural advantages that ETFs also offer, which is not the manager not being affected by the flow of funds, which is huge to me in actively managed mutual funds with the old structure. And I will call the structure that exists now the old structure. It's a less efficient structure, unless anyone would disagree with that. The structure, again, on all this is important. And secondly, some people want to use discount premium against others to make strategies, and some advisors, in fact, do make money for their clients on that. So I would say I saw an interesting graph that basically shows the growth since 1993 of internet users and ETF assets, and they parallel each other, they shadow each other. To what extent, again, we're talking information and education, should all funds eventually wind up, because of education, either closed-end or open-end? Because as Mike pointed out, the advantage to the investor of people's, disadvantage of the investor, supposedly, of people seeing the holdings of the fund manager, so they buy the fund too, that's an advantage, not a disadvantage. If it's the end investor that's there, they're just getting killed by this holding on to the old structure. So to what extent do you see structure permuting? And if all these actively managed assets, if there's still a market for them, what will that do to the ETF structure and the structure of the markets?
I mean, maybe a quick answer from my point of view. There's one big space that it's a challenge for ETFs. If you think about the 401k market, where people are putting in different amounts of money into different types of exposures, the mutual fund allows you to buy a fraction of a mutual fund whenever you want to, and that's what's used within 401ks. ETFs right now, it's difficult and almost impossible on many of the platforms to buy ETFs. So that market, which is large and growing, is right now one that ETFs as a structure don't work well in.
Yeah, Schwab has a good solution on their platform, but you're right, that is a major structural issue.
Yeah, so I think if you look at DC products, defined contribution products globally, it's a space where today the ETFs really don't work. So, and you don't really need to trade every day. So ETFs aren't always the right solution. I think there's times when a mutual fund may be better if you find a good active manager. There's times when futures work better. So I think you need to make that decision of what do you want to do, what is your time horizon, how much do you have to invest, and what are the alternatives?
Yeah, but Acorn has figured it out, right? I mean, they do fractional ETF ownership, so how much of it is just a barrier because people don't want you in the 401k market versus the actual structure of it?
True, but institutionally, most big companies don't use Acorn, right? So the challenge is...
Technology,
Yeah.
the technology is there.
Yeah.
And licensable.
I think we're out of time, but we can take one more question if...
We've been blessed with generally a rising market for the last 4 or 5 years, and the question becomes, what are ETF managers trying to do to prepare for a period when we have a declining market? Because given the nature of the ETF, they have to redeem shares by selling some of their assets, which can accelerate a downward trend in the market. So the question is there anything that ETF managers can do to reduce that volatility?
So just to clear up some confusion, so during a redemption, this is a big differentiator between mutual funds and ETFs. So this is where the in-kind mechanism is truly beneficial. The ETF portfolio already holds those securities. So there's no going out and buying or raising cash to meet a redemption. Those securities are already part of the portfolio. The ETF issuer and the ETF own them. The portfolio manager is managing them. Whereas a mutual fund, if there's a redemption, that portfolio manager then needs to sell off securities to raise cash to meet that redemption. That doesn't happen. So there's that in-kind, so not only is that costly because you have to go through a TA and all of that, so you save some cost on the ETF side, but you also already have that. So if you wanted to redeem, you're going right to the issuer and they're just giving you a slice of that ETF right there. There's no other transactions that need to happen. There's no raising cash. There's no going out and buying and selling. That's part of the beauty of that in-kind mechanism. Those securities are right there. They deliver them. You say 9:30 a.m., I'm redeeming, I want out. By that day, depending on the ETF, you could have those securities in your custody account. There's no selling. There's no run of the market. It's all right there.
Just because the market's declining doesn't mean an ETF issuer has to sell. So most of the trading in ETFs is secondary trading. Yeah. So what Jennifer said is totally true if someone's redeeming, but if you look every day, not every trade of an ETF is a creation or redemption. Most of it is secondary, but if the underlying market is going down, it'll impact the value of the securities in the fund, but it doesn't mean anyone has to trade the underlying securities. So I think sometimes there's confusion about what's happening and what actually happens to ETFs. ETFs will have market move because of price move, and they'll have impact of creation redemption, but most of it is just secondary trading.
And this is a big one of those myths. You know, people don't fully understand. And feel free to ask me, Jennifer, Kim, or anybody on the panel, or really anyone in the ETF space. Like, ETF people get really nerdy when they're talking about ETFs because we've been in this space. We've kind of all fought this fight for years when everyone else is like, oh, ETFs are just the stepchild. Now we're kind of in the spotlight. So everyone who's been there wants to talk about it. So please ask questions. But this is something, understanding the difference. What does Debbie mean when she says the primary versus secondary trading? Those are two big areas of the ETF market that you don't see in a mutual fund. So understanding the differences, how you should trade in both of those markets, how the changes in both those markets changes and impacts you as an investor. So those are all, as we talk about due diligence and education, those are all areas that you want to make sure you understand and ask the easy questions that you think you know the answer to, and maybe you have 98% of it, but that 2% gap can lead to a lot of the myths that are out there, and that 2% gap, and then you hear a headline, and all of a sudden you're catching on to spreading the news as to why ETFs are, causing big redemptions and running on the market.
And an interesting trivia, there's been 51 months of positive net inflows into ETFs. So we've had a lot going on in the markets over that period, and people are still putting money net into ETFs. So it's not like there's massive outflows happening.
All right. Thank you, everybody.